AI capital allocation strategies. How AI decides where to invest your money. Investing successfully is not just about picking individual stocks or bonds. It's about allocating your capital wisely across different asset classes, sectors, and investment opportunities. Capital allocation is the art and science of deciding where to put your money to achieve the best possible balance between risk and reward. Traditionally, this process has relied heavily on human judgment, experience, and intuition, often guided by historical performance and economic indicators. However, in the age of artificial intelligence, or AI, capital allocation is becoming far more sophisticated. AI capital allocation strategies are transforming how investors decide where to invest their money by analyzing massive data, identifying patterns, predicting outcomes, and dynamically optimizing portfolios. In today's video, we'll dive deep into how AI capital allocation works, the techniques it uses, the benefits and risks, and how you can leverage AI to make smarter investment decisions in the US stock market and beyond. At the core of AI capital allocation is data. Unlike humans, who can process only a limited amount of information at a time, AI systems can analyze thousands of variables simultaneously. Traditional financial data, such as stock prices, earnings reports, revenue growth, dividend yields, and debt ratios, are fundamental inputs. But AI goes far beyond these basic metrics, incorporating macroeconomic indicators like GDP growth, inflation rates, interest rates, unemployment data, and market sentiment. In addition, AI models increasingly analyze alternative data sources, including news sentiment, social media trends, web traffic, analyst recommendations, supply chain activity, and even satellite imagery. By combining structured and unstructured data, AI can generate a more complete picture of the investment landscape, helping it determine which sectors, asset classes, or individual securities may provide the best opportunities. Machine learning is the engine that powers AI capital allocation. Supervised learning models are trained on historical data to understand how different factors such as earnings growth, market volatility, and interest rate changes affect asset performance. Once trained, these models can predict potential returns and risks for various investments. For instance, a supervised learning model might identify that technology stocks tend to outperform during periods of low interest rates and high innovation investment, while consumer staples perform better during economic uncertainty. By recognizing these patterns, AI can allocate capital more efficiently than human investors who may be influenced by emotions, cognitive biases, or incomplete information. Deep learning models, such as neural networks, take AI capital allocation even further. Unlike simpler algorithms, neural networks can process nonlinear relationships between multiple variables, identifying complex patterns that are invisible to traditional analyses. For example, a neural network could detect subtle correlations between commodity prices, global supply chain disruptions, and emerging market equities, adjusting allocation decisions to capitalize on these relationships. Recurrent neural networks, particularly long short-term memory networks, LSD, are effective at analyzing sequential data, enabling AI to anticipate market cycles, sector rotations, and trends over time. This allows AI to allocate capital dynamically, adapting to changing market conditions in real time. Reinforcement learning is another key tool in AI capital allocation. Unlike supervised learning, where the model learns from labeled historical data, reinforcement learning learns from trial and error. In the context of investing, AI simulates portfolio allocation strategies, observes the outcomes, and adjusts future decisions to maximize long-term returns while controlling risk. Essentially, reinforcement learning allows AI to experiment in virtual market conditions, refining its allocation strategies in ways that humans cannot replicate at the same speed or scale. This continuous improvement helps AI models make smarter, more adaptive investment decisions. One of the most important aspects of AI capital allocation is risk management. Allocating capital is not just about chasing returns. It's about balancing risk and reward. AI models assess risk by analyzing historical volatility, correlations between assets, drawdowns, liquidity, and exposure to macroeconomic shocks. By understanding these risk factors, AI can optimize portfolios to reduce downside potential while maintaining upside potential. For example, if equities are highly correlated and market volatility spikes, AI might shift a portion of capital into bonds, commodities, or alternative investments to stabilize the portfolio. This dynamic approach to risk management is one of the reasons AI capital allocation strategies are increasingly being adopted by both institutional and retail investors. AI also enables diversification at a scale that is difficult for human investors to achieve manually. Traditional portfolios may allocate capital across stocks, bonds, and a few alternative assets. AI can analyze thousands of individual securities, ETFs, mutual funds, commodities, and even crypto assets, identifying combinations that optimize returns for a given risk tolerance. Furthermore, AI can rebalance portfolios automatically in response to changing market conditions, ensuring that diversification is maintained and that capital is allocated where it is likely to perform best. Another advantage of AI-driven capital allocation is the integration of predictive analytics. AI models do not just analyze past performance, they forecast future opportunities. By modeling potential outcomes based on economic scenarios, earnings growth, sector rotations, and market trends, AI can allocate capital to areas that are likely to outperform. For example, if AI predicts that renewable energy companies are positioned to benefit from government incentives, technological advances, and consumer trends, it may increase capital allocation to that sector while reducing exposure to underperforming industries. This forward-looking approach gives investors a strategic advantage over traditional allocation methods. They rely primarily on historical performance.